we're going to go through 5 dividend paying stocks that you can buy, hold, and completely forget you even own. Welcome back, guys. Today we're going to be looking at 5 dividend paying stocks that you can buy into your portfolio, not do a single thing with, own them forever and ever and ever. And because they're dividend paying stocks, they should give you a small kickback as well throughout the years. So welcome back to the channel. If you're new here, make sure that you click the subscribe button for more. Make sure, as long as the video gives you some value, then you hit the like button, because that really helps out the channel. These are just going to be, there's tons of companies out there that could qualify for this in being buy and hold forever stocks, but this is going to be just 5 companies, not necessarily the top 5 maybe, but just 5 good, solid, you can't really go wrong companies to buy and hold pretty much forever. I said I'm going to keep them dividend paying stocks, so they give you a little bit of a kickback throughout the years as well, and being a dividend investor, that makes more sense and is far more in line with my channel. I'm going to go through a couple of bits of fundamentals for each stock, and just roughly the reason I'm looking at the bits I am. We're going to go into that in the computer in a second, but I'll give you a rundown just briefly of what we're going to look at and why. So being dividend paying stocks, you're going to want to look at a few different things, the yield being one of them, but things like how long they've been growing their dividend for, and whether they've historically paid it through turmoil and bad times as well, like we've had recently. So any companies that have maintained their dividend through what's just happened and is still happening, then great companies to be investing in. We're going to look at the payout ratio as well, so I'll quickly explain what that is. The payout ratio is the percentage of the company's profits that they are paying to their shareholders. So if a company earns 100 million in profit, they're going to be paying, their payout ratio is 60%. They're going to be paying $60 million out to their shareholders and reinvesting 40 million back into the company. 60% is considered by a lot of people the sweet spot. If you've got a company that's 100%, 105%, it means that they're getting to the point where they're actually borrowing money to pay their shareholders the dividend and not able to reinvest the money back into the company. And that means that there's more risk of them cutting the dividend, suspending the dividend, and just no real prospects of them increasing the dividend and growing the dividend, which is what you really want to be looking for. If you've got a company like one of the ones I've got on the list that's got a 25% payout ratio, 25% payout ratio is only 25% of its profits. It means 75% of its profits can be ploughed straight back into the company for further growth, and there's a lot more room to grow that dividend as well. So they're the bits I'm going to be looking at on the dividend side. I'm just going to jump in to the current, not current, the assets and liabilities of the company, and whether they're sort of massively over leveraged and in a lot of debt. I'm just going to look at what it currently has in terms of its liabilities and what it currently owns in terms of assets. There are lots of different things you can look at in each company, in its fundamentals. This will just be one thing I'm going to look at with you guys today. We're not going to look at the current assets of a company, because a current asset is something that presumably you could sell a property or sell anything that would be considered an asset within a 12-month period would be a current asset. So if they're tallying that up in the current asset section, it means that it could be turned into cash within 12 months. I'm going to be looking at total assets, long-term assets that wouldn't necessarily be able to be liquidated within 12 months, because we're looking at this for longevity and for the long haul. So we're not looking at the, getting in and out in a year and has it got good current assets to liabilities, because we're doing it for the short term. We're going to be looking long term, so we're going to be looking at the total assets and liabilities of the company, not just current, which can be liquidated within a 12-month period. So with all that boring stuff out of the way, let's jump into the computer and we'll go through each, go into Seeking Alpha, and we'll go into each company and just look at the payout ratio, the dividend yield, how long it's been growing its dividend for, and its assets to liabilities ratio. So we'll do that now. All right guys, here we are in Seeking Alpha. So let's just begin. Let's go through the companies now. So in fact, they're all going to come up in the list, the drop down list, as you saw there, as I've already obviously done a bit of homework looking into them. So you'll know what they all are. You can just jot them down from the drop down that you see here. So let's start with the Proctor Gamble company. I've talked about this one before. I've talked about probably a few of these companies in this list before. I'm going to show you how to get into the bits you need and the key points. So the Procter & Gamble, this is the first screen that'll come up. It will give you an overview of what the company's done over the last 10 years, over since inception. Well, not quite even inception, but certainly for a very long time, so you can see what the company's done. It will give you the P ratio and the earnings per share and bits and pieces down here. Dividend rate, how much they're paying, the dividend yield, this, that and the other down this side here. If you go into financials, wait for it to load, then go into balance sheet, that tab there, or wait for it to load. So we'll go through Procter & Gamble's assets and liabilities. So I'll quickly go through it here. So current assets that you can see there, current means that they can be liquidated within 12 months. I'm going to be going long-term assets. So if we go down to the bottom here and go total assets, and we'll take 2000 from June 2020 report rather than last report. We'll do the last full report here. Long-term assets, so total assets 120 billion, and then we go straight down to current liabilities, long-term liabilities. We've got 73 here, so they're absolutely fine. It's not like they've got 120 billion in assets and 118 in liabilities. We've got a nice buffer here, nice margin of safety, let's call it. Let's get into the dividends here. So we've got a 2.22% dividend, a payout ratio of 56, which is pretty healthy. It just means that, or nearly 57. So basically this just means on 57 you've got 43% of its profits are going to be reinvested back into the company. So more room for growth, and it's been growing its dividend for 64 years anyway, so little to worry about with this one. Plenty of companies similar to this to throw another one, a little bonus company in there. I guess it's not part of the 5 that I'd be putting down here, but certainly a bonus would be something like another company that I talk about a lot, again, Johnson & Johnson. Do your own homework on that, have a look at that, look it up on Seeking Alpha and see what you think. Next company is Pfizer. So it's a health, in the healthcare sector. So let's go into, well, let's start dividend because it's on the screen here anyway. So payout ratio 52.71, so really good payout ratio again, pretty healthy. It means it can reinvest a lot of its profits back into the company. It's been growing its dividend for 10 years. It's been paying a dividend for a long time, but growing it for 10 years. Quite a healthy dividend yield there, 4%. And let's go into financials. So again, financial tab there. Head into balance sheet, and it will bring up all the bits you need here. So Pfizer 167 long-term assets 167. And its total liabilities 104. So again, a nice buffer there on that one. Healthcare sector, can't go far wrong. Right, here's one of the ones that was a bit of a growth stock, I guess. Apple. Apple, you know, as a buy and hold forever and forget about. You've got to have something like Apple in the portfolio. I mean, it's just, they're such innovators. They're going to be around for a long time. They're just going to be. They've got a fantastic balance sheet. If we look at assets, 338 billion, and its liabilities 248. Apple's got a lot of cash laying around as well. If we go for a nice long graph here, you can just see what it's done in the certainly in the, well, I was going to say in the last 5 to 10 years, but actually even right in its inception, it was still growing at a reasonable rate still. We've got a tiny yield of 0.71, quite a high P ratio as well, but for the long term, Apple, I just think, is a great company to get involved in. 25% payout ratio, as you can see there. So it just means that it's reinvesting 75% of its profits back into the company. Safely be able to pay its dividend for a long time. It's been growing it for 9 years anyway, This payout ratio, you'd safely assume it would be able to grow it for longer as well, because it's only paying out 25%. So if it wanted to grow its dividend, it absolutely can. And just a company that you can't not be involved with at the moment, in my eyes, personal opinion. Fourth company on the list, we've got 3M. Going to be talking about another dividend king, very much like Proctor Gamble and Johnson & Johnson, if you go into that one. So keeping with the dividends here for a second, we've got 62-year growth. We've got a higher payout ratio, but the 62-year growth in its dividends, it doesn't scare me that it's got a slightly higher payout ratio, and I think the other company we're going to look at has got quite a high payout ratio as well. But it doesn't scare me because they've been paying their dividends for such a long time. It's got a 3.46, nearly 3.5% dividend yield, which is pretty healthy. And if we take a quick dive into the financials and we go into long-term assets, 44 on the last figure there, 44 billion. Long-term liabilities here, we've got 34. So again, pretty reasonable buffer there in percentile wise. In percentile terms, nearly 30%, around 30% buffer, which is absolutely fine. And they've just been around for so long. I mean, 3M are famous for originally making the Post-it note, but there's just, I mean, the list of products that they make and the number of patents they apply for on a yearly basis is astronomical, because they're innovators. They're just constantly innovating and inventing new things and new products, and big manufacturer. So almost you'll be using a product of theirs on a daily basis, without a doubt, I'm sure. So the last company we're going to look at, which could be a bit of a fight between these two. So you probably saw it there as I did the drop down. So Pepsi, but you've also got Coca-Cola. So it'd be interesting to see what you guys think in terms of which one you prefer. Let's go assets and liabilities first. So assets, nearly 80 billion, and we've got long-term liabilities at 63. So again, real nice margin of safety there, nice buffer. If we jump into its dividends, 48 years, so it's coming up to being a dividend king. I can tell you now that Coca-Cola is a dividend king. I can also tell you now that Coca-Cola has a higher payout ratio. So 75, nearly 75, 74, 16. So you've got a 25% of its revenue, 25, nearly 26% of its profit is going to be reinvested back into the company. Is that enough? Well, it clearly is, because it's been growing its dividend for 48 years. Is it going to suddenly stop growing it or reduce its dividend? I very much doubt that. But it's just getting to the point where as soon as you start getting to the 80s, 90s, it starts to become a little bit dicey. And certainly I would want to keep it closer to the sort of, really I want to keep it closer to the 60%, the sweet spot. It's got a nearly a 3% dividend yield, which is great, as I said, and it's been growing it for a long time. Now Coca-Cola's dividend yield is higher, it's 3.3 something, I think. but it has a higher payout ratio, but it's been growing its dividends for longer. So it's entirely up to you which way you go about it. Certainly for, you know, the difference between Coca-Cola and Pepsi in terms of its dividend growth, 48 years to 50 something, you know, does it really matter? No, I'd probably personally go for the lower payout ratio. I think Coca-Cola payout ratio is somewhere in the 80s. So I think I'd personally, right now, I'd rather go for the lower payout ratio, just to know that they've got that margin of safety in its profits and payout ratio, and the dividend potentially being able to grow its dividend in the long term as well. So that's it, guys. They're the 5 companies. So as I said, we've got Procter Gamble, Pfizer, Apple, 3M, and Pepsi. Johnson & Johnson has a little bonus company in there, and you could decide on Coca-Cola instead of Pepsi. One of Warren Buffett's obviously favoured companies, Coca-Cola, and he's a far better investor than I. So you may want to go for Coca-Cola instead of Pepsi. And that's it for in here. So I'm going to kick you back out into the big wide world. Alright guys, so hopefully that wasn't too boring for you, going through all the current assets and liabilities. Hopefully that may have helped you a little bit in terms of, well, you might look at companies in a bit more detail now. And again, I'm by no means an expert at this. That is a very brief overview of the companies. A lot of these companies are talked about quite a lot as well online, and once you start looking into them, it becomes clear why people talk about them online and why they are considered such great companies to buy. So, as I said, by no means an expert at this. Do your own homework and research and look into your own companies if you want to look at them for the long haul. This is only a list of 5, by the way. There's hundreds of them out there that would be fantastic purchases for the long term. So as I said, hopefully that was beneficial to you in some way. Hopefully you got maybe a little bit of value in that, and it gave you an insight, maybe just a little bit more into the stock market, and hopefully gives you maybe a bit of confidence that some of these companies have been paying out a dividend for 64 years. Maybe it starts to take away some of the fear in the stock market potentially. Who knows? You'll have to let me know in the comment section whether that was sort of helpful to you in that sense. So throw something down in the comment section, we'll have a conversation about it. Whether this video has helped you, what companies you'd be looking at, whether you would be buying Pepsi or Coca-Cola. Do let me know, because I find that very interesting. The arguments either side for those 2 companies. So pop a comment down below and let me know what you'd be investing in. And that's it. Until next time, guys, I'll see you in the next video. See you later.